So this is the unemployment rate U3 NEE Part 2 by Andrew Tom and Seth Gross. So forecast 1 for our prediction this year is that the GDP, the real GDP, rose at annual rate of 3.2% in the first quarter of 2019, and the CPI rose by 0.3% in April 2019. For the U3 unemployment as of April 2019 is 3.6%, which is 5.3% decrease from March's unemployment value. For the index of leading economic indicators, the LEI for the US increased by 4.4% in March 2019 to 111.9 from 100 in 2016. And although the gain this March is significant, gains are expected to slow down over the course of this year. And our overall prediction is that the U.S. economy will continue to prosper, but its growth will slow and stabilize over the course of this year. So our forecast 1 expert opinion from the money section CNN, we can see how the economy was doing. The economy seems to be doing quite well according to the indicators and Trump's tweets regarding the economic situation in the United States of America. There are multiple reasons that this expert opinion states is the main for this, some of which are the unemployment rate, lending, and stock increases. And we can predict that the country will continue to do well under the Trump administration due to the current positives we see through the economic indicators. So for our models, for the first model, we see that the unemployment rate is at a low for the past years, for a few years. Having a low unemployment rate is good, and that means the economy is doing quite well. The second model we used was an average hourly earnings of all employees, and this model shows that after almost 10-year fall in the hourly wages from the Obama administration, the Trump administration is starting to bring the hourly wages up, and this is good because it supports the United States economy and it's doing pretty well. A geopolitical event that could affect the economy would be an earthquake in one of the OPEC countries, which damages some infrastructure, and the oil coming in from the Middle East might be lowered and could damage our economy. And another geopolitical event could be extreme corruption in an African country that could limit our imports on the earth metals we get from there. So our prediction for next year would be that from this article we know that the 2020 economic recession isn't happening, and investors expect the GDP to remain around 2.5% on a quarterly basis for the rest of the year, and there's no recession in sight here at home, and there's no recession on the horizon in China either, which we have a link with. And there are some opinions on why this is not happening, and one of the parts from the article was that the earnings season is coming in healthier than people expected 3 weeks ago. Most companies' earnings are coming in better than we thought, says Scott Clemens, chief investigator strategist for Brown Brothers Harriman in New York. We see no earnings recessions coming at us, and the highs in the S&P are similar to where we got in October. So the indicators for forecast 2 was the U.S. GDP is predicted to grow to $289.31 billion by 2020, and the U.S. CPI is forecasted to be 263 in 2020. Unemployment in 2020 is forecasted to be at 3.6%, and LEI is currently 111.9, and it'll stay positive in 2020 most likely. So the models we had for this was that real GDP is expected to grow at a slow pace, and this is okay. So we have a real GDP growth, and this shows that our economy has no sign of entering a recession anytime soon. And it does indicate some chance of economic stagnation, but it's still okay because we're not going to see that dreaded recession. And so, yeah. The second model we have is unemployment levels are expected to experience a little change in the next year. This is, if anything, good, as they are. This is, if anything, good as they are already low, and the stability in the unemployment rate indicates a stable, secure economy. So geopolitical events are that Trump could declare another trade war, and this could cause an unpredicted economic downturn. And U.S. and North Korea tensions could suddenly escalate, and the stock market downturn as investors could be wary of this escalation. Future predictions would be that U.S. GDP is predicted to grow to $23,874.93 billion by 2022. The U.S. CPI is forecasted to be 279.71 in 2023, and unemployment will be in 2029. It will be forecasted at 4.7%, and since the current LEI is 111.9, it'll likely stay positive in 2029, but there is a chance it might be negative because it's unpredictable. So the future jobs available, there's going to be a large variety of jobs available once we graduate in around 2022, 2023. But some of the top jobs are in tech due to the increased presence of technology in daily life. Mobile phones are a must for most people, and therefore app developers have come into demand. Other tech jobs are hot, like information systems and security, as well as data infrastructure managers for companies. And becoming a physician is also hot due to the growing population and need for more doctors and nurses to help people. Some of the more cool jobs would be like radio or talk show and podcast workers, because radio stations have to compete with other forms of audio entertainment, such as music streaming services, which are dominating right now. And online talk shows are kicking these traditional radio and talk show hosts off the air due to the better technology and the lessened need of people or workers for managing these traditional stations. The future expert prediction is that if economic policies remain the same, economic growth will slow down and will fall below the historical average due to the waning effects of the previous fiscal stimulus. It also predicts that national debt will rise to equal 93% of our GDP. So, in the article, we see that in CBO's projections, deficits remain large by historical standards, and federal debt grows to equal 93% in 2029. The effects of fiscal stimulus wane. It's going to be below the historical average. CBO regularly publishes reports presenting projections that indicate whether federal deficits, debt, revenues, and spending, and the economic path underlying them would be for the current year and for the next 10 years if existing laws governing taxes and spending generally remain unchanged. And this is the latest report in the series, and that in this series the budget deficit is about 900 billion in 2019, exceeds 1 trillion each year. So future expert prediction is that the U.S. growth in real GDP will stagnate over the next decade, and this is not good in the face of mounting government debts and a national economy that's set to stagnate. And the amount of federal debt held by the public is set to increase to record levels, as in the ratio of federal debt to GDP, and this increase in debt will increase interest rates, slow business growth, and slow economic growth. And so scenarios are that Democrats might raise taxes, and although this could be a short-term slow economic growth, it can have the beneficial effect of lowering our national debt. And the Trump administration's deregulatory policies, although they resulted in short-term economic gains, they could ultimately lead to economic decline, increasing socioeconomic inequality. And if a recession occurs late in the 2020s, there could be a substantial economic decline much larger than the stagnation or slight reversal of economic growth predicted by current models. And these are sources 1 through 12.